Hey, good afternoon, everybody. This is Carl Streck at Mountain Seed. Hope you're having a great day. We're going to go ahead and get started with our monthly webinar series. So really excited about this one. We're joined by some experts in the hotel and lodging industry from CBRE Hotels. So I'm excited to introduce them. As you guys know, at Mountain Seed, we serve hundreds of banks nationwide with appraisal review, commercial appraisal review, residential appraisal review, and a variety of other things in the appraisal process. I know we've got a lot of our clients on the call, so thanks for joining us today. But one of my goals personally is to continue to add value to our clients and prospects in ways that go far beyond appraisal review and appraisal process and compliance. So one of the ways is taking industry experts and putting them in front of our clientele and our friends and prospects. So really excited to do that today. So without further ado, I'm really excited to introduce Scott Smith and Mark Woodworth from CBRE Hotel Group. As a little bit of background, and I won't take too much time, don't want to steal their thunder. A little bit about Mark. Before joining CBRE, Mark was a partner and industry chairman of the hospitality industry consulting practice for Coopers Lebrant. He's also a frequent speaker at industry conferences. He's a Dean Distinguished Lecturer at Cornell University and a member of the Conference of Business Economists, as well as the Hotel Development Council for ULI, the Urban Land Institute. So definitely an expert in this field, and as well as Scott Smith, one of his colleagues, is managing director of PKF Consulting. He's located in Atlanta, Georgia, which is where Mountain Seed's headquartered. Has over 20 years in the hospitality industry, both as an appraiser, Scott's an MAI, and as a consultant. So without further ado, I'm going to turn it over to Scott and Mark. Thanks so much, guys.
Okay, Carl and Melanie, thank you for the opportunity. This is Mark Woodworth, and Carl, not to correct you right up front, but when you introduced Scott, you neglected to say that he was my favorite colleague. And, Scott,
yeah, I did. Somehow that got left out of his bio. Sorry about that.
Oh, there you go. Okay, but anyway, thanks, Carl and Melanie, for the opportunity to for Scott and I to spend a few minutes this afternoon with, as you say, your clients and other folks that you do business with and so forth. So let's get right into it. We're going to focus on the domestic lodging industry and give you some of our overall thoughts as to where we've been, where we are, and perhaps most importantly, where we think the industry is headed as we march forward into 2017. For those of you that may have heard us give a presentation before, I guess me particularly, I always like to have a theme to the remarks to kind of set the stage for what we want to cover with you today. And the theme is right now, I think, is very appropriate for the domestic lodging industry is leaning towards the upside. Times have been good, as I'm sure you all are aware. They've been good, they are good, and most importantly, we think they're going to remain good. And in fact, we readily acknowledge that our forecasts are rarely 100% spot on. We think we're pretty good at it. We come close, but we always like to give a sense for if, where's reality likely to be if we don't hit the forecast on the nose. And right now we think that the cards are lining up to suggest that the near to midterm future might actually be a little better than what we've been forecasting. And again, we want to share some of the reasons as to why we think that. You'll hear throughout the presentation today that Scott and I are going to try to keep this as informal as we can, and I'll generally lead the discussion, but I've asked Scott to chime in wherever he feels like he wants to add to the discussion. So with that teeing it up, leaning towards the upside, here's what we want to cover today. We think it's critical that you understand what the economic assumptions are that inform our thinking with respect to where the hotel industry is going. It's very clear from studying the past three lodging cycles going back to the mid-'80s that lodging demand is inextricably linked to the overall economy, so we're going to share that with you. One of the more topical issues in our industry today is Airbnb and the sharing economy. Lots of questions we get constantly from our clients is Airbnb something we should be thinking about? Is it affecting our business? How might it affect demand and industry fundamentals going forward? So we want to share with you some of the research that we've put together on that. Get into our forecast. We literally just updated these within the last week to 10 days, so they're fresh, hot off the press. Each year, Scott and the rest of our colleagues, we collect roughly 7,000 hotel financial statements, and we warehouse that data, do a lot of analytics, and we want to share some of the key things from what we see in that right now, and then conclude with a brief discussion on cap rates, where they've been, and where we think they're headed in the near and midterm. So with that teeing up, let's get into the economy. A question that I always like to ask folks, and again, clients and friends and so forth that we're with, is thinking about the economy and where we're headed. And I would ask that each of you kind of answer this question for yourselves, because Scott is an MAI. I decided to make it easy to give him the three possible answers, same, better, or worse. I will tell you that as I have the opportunity to go around the country, speak to a number of different groups, that the consensus view has been pretty consistently for the last 90 days that the economy going forward over the next year, if it's not the same as it is right now, it's going to be better. Lots of uncertainty in the marketplace today, without a doubt. A lot of it comes from the new administration and trying to figure out what actually is going to happen. But the consensus view seems to be, pretty consistently somewhere between that same and maybe even better over the next year. Talk about uncertainty. I want to spend a few minutes on this. As you see the source here, policyuncertainty.com, this is an index that some academics put together, I guess, more than a few years ago, and it monitors what uncertainty in the marketplace. And again, a lot of questions about the Trump administration and how that might affect things. What we show here is the last 15 years worth of data, and if you can draw a line at the 150 point on this index, the index is made up of everything from scraping headline news stories from 10 of the largest daily newspapers. Another input to this algorithm is the number of tax laws, tax regulations that are set to expire, and it's factors like that go into coming up with this uncertainty index. And if we draw it at the 150 line, you can see over the last 15 years there's been some spikes. Certainly we go back to the events of 9/11 and the wars that followed. We saw elevated uncertainty. We saw the depth, the Great Recession, what happened in late 08 or early 09, and various events that occurred through the Obama presidency. And you see on the far right, it seems like that uncertainty line has begun to tick back up again. Well, that's what happened. That was a surprise with the election outcome. Thought it might be interesting just to benchmark it. The last time we saw that kind of surprise was back with the Bush-Gore first election, and as most of you probably remember, it took 30 days to pick a winner on that one. In looking at a more recent time frame and some of the uncertainty that's occurred in the marketplace, again, that was the Brexit vote from last summer. Big surprise to most people. Again, there's the elections, and you can see on the far right that uncertainty index remains fairly elevated. What we would point out is what most of us do when we're not certain about something, if we can, is what we do is we do nothing. We wait for the uncertainty to dissipate, and then once we're more comfortable as to where things are headed, whether it be policy, whether it be the economy in general, what have you, then we will in fact begin to engage in whatever behaviors it is that we're planning on doing. So we've had elevated uncertainty. Now, this is an index that comes from a quarterly survey from the National Federation of Independent Businesses. It's been, as you can see here, for 40 years now they've run the survey. The point we want to make here is that in the reading from December of 2016, which is the line you see in the blue, from the movement from November to December, that's the percentage of their members that feel the business conditions are getting better or likely to get better over the next 6 months versus worse. What we saw in December was the largest single monthly increase that we've seen in that measure going back to the first Reagan term back in the 1980s. So we found it very interesting that that's one indication that there seems to be a lot of optimism, at least within the small business community, about where the marketplace is going. If we think about why do we care about the economy? I touched on this earlier. Lodging is cyclical in nature. We have the benefit from the data compiled by Smith Travel Research to be able to go back to the mid-1980s, and we can look at past cycles, and then it helps to inform our thinking as to how we might be able to project, forecast the future. We know from our research that employment and income correlate very closely to demand for hotel rooms. That's held very, very consistent. We also look at leading economic indicators developed by the Conference Board that they can help us when we, in terms of predicting turning points. What we do know right now is that that's probably one of the biggest questions, Scott, that we get is, boy, the end's got to be close. Tell us when it's going to get here and what it's going to look like. We don't think it's near yet, but again, we're going to talk a little bit as to why we think that is. Not to let the cat out of the bag here, but net is where we sit today. We felt this way for comfortably the last 2 or 3 years now, is that the outlook remains very, very favorable for at least the next couple of years, and perhaps an argument can be made that it'll run to the end of the decade. So we're going to talk a little more about that during this call today. This is just a graphic illustration of the various milestones along the lodging cycle. You can see on the far right where we were a year ago, where we are today, and the amount of progress. So we're clearly getting to the peak of the cycle. Development has been picking up. It's beginning to accelerate, certainly in some markets. If you look on the far left-hand side of the screen, historically, this phase of the cycle has been consistently characterized by rapid development. But again, we're seeing it pick up. Some markets are getting a lot of new rooms, but from a macro perspective, we just don't see lots of new construction to the point where it gives us any angst about the strength of industry fundamentals. Now, I mentioned the connection between lodging demand and the economy, very close linkage with changes in gross domestic product. That's what we show you here. For illustration purposes, we like to break down GDP into the 4 primary component parts: government spending, trade, business spending and investment, and then critically consumer spending. And then we map that against the pink line you see here from SDR. To the left of the forecast point, to the right is our forecast. And you can see that they do seem to move in sync. What we would point out from this data, and this has been particularly true in the current cycle, that it's changes in business spending and investment as well as consumer spending that does correlate most closely to changes in lodging demand. That is held very consistent for the last 2 or 3 years, 3 to 4 going on now, and to the degree that holds true, which we think it will. If you see the component parts of where GDP growth is expected to go in the balance of this year and into next year, it's those 2 areas that really mean the most to the hotel industry. So again, that makes us feel very good about where we're headed. This is the LEI I made reference to earlier. This has data. This mislabeled here. This is actually has been updated through the end of the year. What we would point out here again is there's a very close correlation between these 2 data series, the light green line being hotel demand, and the LEI indicators, the change over the preceding 6 months. They do move very much in sync. It did reach a bottom in the 3rd quarter of last year. You see the dark green line, but it has begun to move upward, which again gives us some confidence as we move into 2017. Lastly, I want to just touch very quickly, those of you that are engaged in and involved with opportunities in some of the key gateway cities around the country, whether it be Miami, New York, certainly LA, San Francisco, that what we know is there's a very close relationship, and it's an inverse relationship between the strength of the U.S. dollar and the volume of travel and tourism spending here domestically from international travelers. That's very clearly shown in the series here, where you see that the light green line is the currency series, and then the dark green line is the travel series and how they do move in opposite directions. So from the research that we've done, we do know that strong dollar is felt particularly among upper priced hotels. I think upper upscale and luxury. They do tend to feel it much more so than other types of hotels. It does have a negative impact on lodging demand. Within those upper price category, luxury is absolutely the most sensitive to that strong dollar issue. From what we read and so forth, we don't see that strong dollar concern dissipating anytime soon. And as you can see here are the markets that, from our research, has shown that upper priced and particularly luxury hotels in these communities are facing a pretty significant headwind from that strong dollar, diminished levels of inbound international travel. So let's now talk about Airbnb. So Scott, not to put you on the spot here, but is Airbnb a threat?
Depends upon what market you're talking about.
Okay, so you can see Scott's clearly a consultant at heart, because the answer began with "it depends." But that's okay, but I agree, it does depend. What we will point out is that we only have roughly, for the nation as a whole, we only have a little more than 2 years worth of historical data on Airbnb. We get it from a firm by the name of AirDNA. That's critically important in understanding we don't have enough history yet to begin to empirically answer the question, is it a threat? What we want to walk you through today, however, is some observations that we've been able to develop over the last couple of years, and in some areas that we're looking very closely to try to get to the bottom of, is this in fact a threat? So we get into that, if I can advance the screen here. Uh-oh. Hey, Carl, are you there?
Yep.
My screen seems to be frozen.
All right. I can see your mouse moving.
Okay, there we go.
There you go.
Sorry.
Man, glad you asked for help. Glad I helped
There you
out.
go. Well, you're a magician there, Carl. Don't go far away. So unlike traditional hotels, as we note here, one of the things that's very important in understanding the influence of Airbnb, it's, as we describe here, it's a very fluid supply, meaning, unlike a traditional hotel, that you build it, it's there 24/7, maybe it lasts for 30, 40 years, what have you. With respect to the Airbnb inventory, what we've seen is it responds to market incentives. And what we mean by that is when demand picks up and prices are high enough, the owners of these units, i.e. called hosts, they will in fact list them on Airbnb and the other, HomeAways and One Fine Stays and a number of players in this space. So they respond to the demand when the demand is present, and they can respond very, very quickly. Airbnb is clearly the number one provider in excess of 3 million rooms today. But again, globally there's over 80 firms that are in this business.
An example of that would be like New Orleans. So during Mardi Gras, you probably have a lot more Airbnb down in Mardi Gras, down in New Orleans at that point in time.
Yeah, no, you're absolutely right. That's a great example. Think of Super Bowls, or when the Pope came to Philly, the political conventions. We saw in D.C. around the inauguration a month ago that, again, the supply of units surged.
But at that time, though, the hotels are in theory also operating maximum.
Well, at least historically they have, but that'll be one of the questions that we're trying to answer. We mentioned the idea that the Airbnb hosts respond to incentives. And what we mean by that specifically is when revenue per available room, or RevPAR, picks up in markets, there's an opportunity to make some money, and so the participants respond to that. Now, having said that, there's been a lot of energy expended, particularly on the part of AH and LA, looking out for the traditional hotel space and trying to establish a level playing field between, as we call them now, traditional hotels and Airbnb participants. This is Google Trends data. Just very quickly want to illustrate the point how the popularity of Airbnb and the other firms in the sharing economy lodging space has grown both domestically on the left side and what you see on the far right side. Again, Airbnb is clearly number one. That's the dark green line that you see there. What we will point out, as you look at the right side in the global piece of this, that Airbnb is actually much more popular internationally than it is in the U.S., although it's very popular here already. We think that's particularly relevant to keep in mind because as international travel continues to grow, and again, the strong dollar is a bit of an impediment, but directionally there's no question it's getting bigger, that a lot of these international travelers are conditioned to availing themselves or at least seeking and exploring the availability of Airbnb. So again, another implication for industry going forward. If we just look at the year-over-year growth in Airbnb and just virtually any measure you want to take, just the number of units available, the supply of those units in total, what the demand, the revenue, up almost 150% to $6.8 billion in the U.S. last year. You see the occupancy, roughly 50%, but you can see that RevPAR growth, 14.2%, was substantially greater than what we saw, the roughly 3.2% that we saw in traditional hotels last year. So watching that very, very closely. And again, trying to assemble as much data as we can on this. Some research done by Morgan Stanley, as well as STR, and it talks about where they surveyed people that actually used Airbnb for their lodging needs. You can see that going back to 2015, that the leisure travelers has doubled up to 25% estimated for this year, and perhaps somewhat surprisingly, more and more business travelers are availing themselves of Airbnb. So that alone would suggest that that is a very important reason to continue to monitor this space very, very closely. If you look at the length of stay at Airbnb facilities, you can see that a big chunk of them, it is 30 or more days, but the 1 to 6 days is a little over half, the biggest single piece, and then you see where the 7 to 9 day. So it's very much an issue that we think, again, needs to be watched very, very closely. Again, getting back to some of the Morgan Stanley research, this is an indication of, again, people staying in Airbnb, where had they been staying during the previous 12 months. And you can see in 2015, 2016, 41, then 49% of people that stayed in Airbnb said that, well, I used to stay in a hotel. So again, it's anecdotal information, but again, it's an indication of why we need to continue to watch this very, very closely. We have developed an index of Airbnb, which basically looks at percentage of the traditional supply represented by Airbnb, the price differential, and how quickly they're growing. What you see here is in New York City, roughly for every 5 traditional hotel rooms, we now have an Airbnb unit. So it's a very substantial piece of the total. And you can see for the other top markets around the country, in just about all cases, it represents a pretty sizable component of the overall lodging space available in that particular market area. Morgan Stanley, again, going back to some of their research, this is what their estimates are, is how they think Airbnb affected U.S. RevPAR. So given that 2016, we actually ended up at a 3.2% RevPAR, their estimates, assuming they're correct, roughly we would have lost, that's about a third of that would have been Airbnb. So let's, interesting estimate. Again, very quickly going through the rest of the Airbnb picture. Again, trying to illustrate how is this affecting pricing in certain markets. This shows, going back to 2002, what the average daily rate premium traditional hotels earned in the month of March relative to the annual ADR earned in Austin. Again, this is for lower priced hotels in Austin, Texas, on an annual basis. So i.e., because of the South by Southwest festival, which is huge, attendance has grown dramatically. You see the pink line there. what's been very interesting is starting back in 2014, we began to see that premium began to dissipate. Still very substantial, but because the attendance continued to grow, what we do see from that is it's the growing presence of Airbnb. It also happens to be where HomeAway started, that the sharing economy seems to be eating away at that pricing premium that the traditional hotels, particularly lower price properties in Austin, have been able to realize. Again, very quickly, almost to the end of the Airbnb story, the way to read this particular chart is to look at, see how they've grown. And if you look at the far right on the lower side, Los Angeles and New York, there's a couple of the much more mature markets that we see domestically, so they haven't grown quite as much. Orlando really spiked up over the past year. We saw a lot of the vacation rental companies begin to put inventory in there. But overall, you can see that the growth, looking at the y-axis, has been upwards of 100% year over year for a number of these key markets. So very quickly, to get into our forecasts, what we want to show you here is the level of supply growth that we've seen across the 60 cities that comprise our Hotel Horizons forecast universe. Excuse me, and what we're simply showing here is the year-over-year percentage increase in supply that was realized. And the point being, of our 60 markets, roughly a third of those, we saw supply growth over the past year greater than 2%. Now, the 2% is a benchmark that we look at closely, because that represents the long-run average net change in available supply at the national level. So over the past year, roughly a third of our markets were above that 2% threshold. If we now take a look at our forecast for this year, that 19 markets now grows to 46. So we're actually getting to where we think 2-3 years from now we'll look back. This is going to be the peak. This year and next will be the peak that we see in the U.S. in terms of overall supply growth.
And I just want to chime in here real quick, as these charts indicate, the lodging, forecast is market to market specific. So when you take a look at Nashville, for instance, they're running at very high occupancy levels right now, and you look at their increase in supply. So when I'm underwriting an asset in Nashville, where for the past 5 years the market comp set has been at 80%, I know 2, 3, 4 years down the road that I'm going to stabilize that occupancy probably in the mid 70% range. Because at some point in time, new supply is in fact coming into that market. So it really is a market to market when you're looking at these different forecasts that we have to try to recognize what this impact on the supply is going to be for those very high performing markets.
Okay, good. Yeah, thanks, Scott. Very helpful. Okay. So the question may be, who cares about supply? Okay, having heard you say all that, well, I care about supply. I think these numbers will help illustrate the point. Again, if we take the 60 cities that we track very, very closely and do a forecast on every 90 days, and conceptually we put them into two buckets. Those markets that have had supply growth of more than 2%, and those that have supply growth of less than 2%. Looking at it based on year-end actual data from 2016, there were 20 markets last year that fell into the high supply growth. Interesting enough, their occupancy level in aggregate was 71.7%. In the lower supply growth markets, it was 69.5. It was actually a little bit lower. But if we look in those high supply growth markets, we had a slight decline in RevPAR last year. And in the low supply growth, you can see we had a very, very attractive increase in RevPAR. So that's starting to see where these new rooms are showing up. Now, if we look at what we're forecasting to happen in 2017, you can see things will begin to get a little better. Lower occupancy, we think rates will start to get some traction, but again, they won't be nearly as healthy as we saw in the low supply growth overall markets. Now, if we just to show you how a few markets can really skew the numbers, what we're doing here is of our 60 cities, we're simply taking Miami, New York, and Houston out of the mix. Again, just to illustrate how a few markets can really skew the macro numbers. So the 21 ends up becoming only 18, okay? And you can see what had been a slightly negative RevPAR, actually for the across the 21, actually was a plus 2.3 for the 18. So one takeaway, Scott, there is just how soft things have been in Houston, New York, and Miami.
Yeah,
the oil, the dollar, lots of new supply, et cetera. And then again, just look at the data for, not surprisingly, a similar impact on the expectations for 2017. So again, the takeaway, as Scott mentioned a minute ago, each market's local. Each one's got to be studied individually. This just simply shows the comparison between all 60 versus the 57 markets. So again, this is our current forecast. Again, just got updated within the last week to 10 days. What we point out is in 2015, that 65.4 was actually a new record. It was set back in the mid-1990s. We actually exceeded that again in 2016 at 65.5, according to SDR. That led to a nice, attractive, slightly above long-run average increase in average daily rate, and which brought us in right at a RevPAR change equal to the long-run average of 3.2. We don't think things will be quite as robust in 2017. They're going to be good, certainly when you benchmark them against the long-run averages shown on the left, and within that particularly, look how high that occupancy level is versus the long-run average occupancy of 62. But you do see supply growth continue to pick up, so that will soften the fundamentals just a little. One other thing that we like to look at closely, because it does link to the level of new construction that we will see, that history tells us that when RevPAR levels return to their previous peak, that is typically an indication of when new construction becomes economically feasible or economically viable. Not 100% of the time, but it's a pretty good predictor. And so what we've done here is looked at our 60 cities and simply compared the year-end 2016 RevPAR level in real terms as compared to that market's previous peak RevPAR level, again, it's expressed in real terms. And what you see, as Scott alluded to earlier, Nashville's on fire. I mean, the real RevPAR levels today, or at least year-end 16, they were almost 40% higher than the previous peak, which is just extraordinary, but then it also helps explain why we're seeing all the new construction going on, the new supply opening up. So you can see the experiences does vary quite a bit as we move across the 60 cities in our universe. Roughly a little more than a third are absolutely in the expansion mode. They're above their previous peak. But perhaps interestingly, somewhat more than that, still haven't recovered. As good as things have been, they're still working their way back. There are a handful of markets, literally a handful, 5 of them, that actually fully recovered, expanded, and now have begun to contract again, i.e. they're in recession. And they're shown here: New York, Pittsburgh, Houston, Albany, and Miami.
2 of those are oil related.
I was going to say, yeah, good point. And in 4 of the 5, it's economy driven. There's something going on in the economy. Most of those, it's energy related, you say oil and so forth. In all 5 cases, we've seen significant supply growth. So it's a combination of local economic conditions not being favorable, exacerbated by the fact we've had lots of new rooms open up. So things are tough in those markets, and so if you're looking there, again, it suggests certainly be cautious. Again, at the market level, you see the variances across cities. These are the top 5, the bottom 5 in our 60-city universe in terms of supply growth that we're expecting this year. You know, Austin, there continues lots of cranes out there, but yet you've got other places, Hartford, Oakland, et cetera, really not much happening. Not surprisingly, if you look at who's going to have the greatest and least change in average daily rates next year, it is the weaker markets that we talked about a minute ago. And you see some markets, particularly the Inland Empire or the Sacramento area, Oakland being outside of San Francisco. The D.C. market seems to be poised for good recovery this year. That the outlook looks very, very favorable. As we look, another way that we look at the industry is by chain scale, using the STR definitions for that. What we would point out here is that we were coming off of the depth of the 08, 09, early 2010 downturn. We saw the luxury, upper upscale and upscale, i.e. the higher price categories, really began to come back first. In 14 and 15, particularly 14, really everybody had a great gain year over year. What we began to see in 2015 is that the lower price categories that were playing catch up really began to power ahead. It was pretty much equally dispersed last year in terms of the RevPAR increases across the various chain scales. Some of you may be looking closely and realize, well, how can the all hotel RevPAR have been 3.2 last year and none of the chain scales are equal to 3.2? The explanation is when we don't show them here, are independent hotels. And as is very common in this part of the cycle, independent hotels are largely have been playing catch up, and they grew at a much stronger rate than the national average did last year. That won't be quite as prevalent in 2017, but where we see the market heading is, again, we would expect typically that the lower priced hotels are going to have a stronger year this year, a little bit of occupancy gain, even more so on the average daily rate side. So again, as you look at your markets, something to consider. I mentioned we get lots of detailed financial data. Right in the middle of our radar screen today, we think about hotels is looking at labor costs. And the chart that we show here has a combination of data from the Bureau of Labor Statistics, that's the pink bars, which shows the year-over-year change in hourly compensation for leisure and hospitality employees. That light green line is the level of unemployment. Not surprising, I would expect for most of you, that there is an inverse relationship between the two, meaning that as unemployment goes up, which is clearly what we saw in the 2010, 2011, 2012 periods, less pressure on labor costs, i.e. there's more labor available. So the year-over-year gains in prices are not nearly as pronounced. But as we saw the unemployment rate drop significantly, what we do see is the offsetting effect in hotels of very significant year-over-year gains in labor costs. That's particularly important for hotels in that, depending upon the property type, 43 to 45% of all expenses in running a hotel are labor and related. So, i.e., the more employees you have, the more you're going to be concerned about that. I think, Scott, you were talking to me earlier, particularly as we think about limited or focused service hotels versus full service hotels, that has some real implications.
Sure.
Right there. So here, just one more data on the labor side, data point on the labor side of things. Here we're looking at productivity measures, where the dark green component of each of the bars represents the year-over-year change in the number of hours worked in the hotel. That light green is, again, the BLS data for average hourly compensation. And the blue line is from our database, the percent change in labor costs. And where we see happening here is that when you see the bar being consisting solely of the light green, that just means that the compensation is going up. We're not getting any more hours work, so that's an indication of lower levels of productivity. What we see happening, and anecdotally from the statements we've received thus far, that the way managers began to combat that in 2016 is they began to cut back on the number of hours worked to try to get more for their labor dollar. We think we're likely to see that again in 2017. Another thing we would point out is where we are at this particular point in the cycle, that expenses rather overall are going to be growing slightly at a faster rate than will revenues. Therefore, that tells us that the profit margin will be contracting slightly. profit dollar amounts will continue to go up. We remain confident of that. But again, the margin is going to be contracting slightly. And again, we attribute a lot of that to just what's going on in the labor side of things. But overall, you can see from where we were at the depth of the Great Recession to where we ended up last year, nice recovery on overall profits measured on dollar per available room. We see increases going forward. That actually takes you through 2019. But again, those year-over-year gains are not going to be quite as robust as what we've seen over the last 4 or 5 years. Cap rates, don't want to spend a lot of time on this. I know, Carl, we're getting near the end of our allotted time here, but what we're showing you here is we do have a cap rate forecasting model that's driven off of the 10-year Treasury and the Moody's BAA bond rates, as well as historic cap rate data from RERC, as well as Real Capital Analytics, as well as our own proprietary transaction database. And what we want to point out here is the green line is the spread between that Moody's AA rate and the dark green line, the cap rate. That real estate's the risk premium relative to the Moody's AA rate, and then the light blue is the 10-year Treasury. And the key takeaway there, for us anyway, is you can see how the risk premium has varied as we move through the cycle of both the 90s. You saw that risk premium really lift back in 9/11 and what we saw SARS and the war and the spread. And it began to contract again as the industry recovered strongly in the mid-00s. You saw the Great Recession come in, but you can see that overall hotel cap rates have remained fairly flat. And critically going forward, we think that the prospects for continued profit growth, comparatively limited levels of new supply in most markets, we think is likely to keep that hotel risk premium fairly stable for the balance of this decade. So we'll see, and that's what's shown here. So don't focus too much on that dark green line in terms of the level, the 8%, but rather when we look at it, we're really kind of seeing the period-to-period movement and how do things change over time. And again, we think that relative to 20-year history going back to the mid-1990s, we think that overall cap rate is going to remain comparatively lower. So we'll see. We hope we're right. So to summarize it all up, the vast majority of our markets, the fundamentals look really, really good. We think they're going to stay there. We're confident in the prospects for growth through not only this year and next year, but probably through the end of the decade. Those high occupancy levels, should we get a push-up in demand, should give, it's not built into our forecast, but it does set the stage for some very attractive rate increases if we can, in fact, get that surprise lift on the demand side of the equation. There's no question that the level of new construction is going to continue to accelerate. But as we said, we don't really see that threat of overbuilding being an issue in very, very many markets domestically. That high occupancy levels well above the long rate average is going to help revenue growth going forward. We talked about labor being an issue. Profits, however, should be good. So, very steady, but some may say really unremarkable, but steady. We think durable is probably a term that fits today, are to be expected for the near to midterm. And again, as we talked about, all markets are different. Some are certainly going to be better than others. And if our numbers are not spot on, as I mentioned at the beginning of our remarks, we think that the surprise could very much be to the upside. So let's hope we're right. So Carl, that's it as far as the prepared remarks that we had. And if there's time and any questions, we'd love to try and answer them.
Yeah, absolutely. Want to open it up for questions to the audience. If you can, just type your questions into the question box there on your GoToWebinar screen, and we'll answer those. A couple of folks wrote in during the presentation about getting copies of the slides. Yes, we will send out slides. We've been recording this broadcast, so we'll send that out as well. I had one question that came in, a written question, while people begin to ask others. It is more granular, so I don't know if you guys will be able to answer it on the fly. But along the similar lines of, and I think this question came in 2 minutes before we started, so without the benefit of hearing the rest of the presentation. But this question was specifically about Southern California and the trends in their marketplace. Should they expect, like you've talked about in the broader market, areas like Southern California, other areas still seeing increase in ADR, occupancy, property sales, or is there a leveling off? And I understand every market's different. You might not know specifically about Southern California, but as a follow-on to that question, you took out 3 markets, Houston, Miami, and one other market, and there was a dramatic difference in the numbers. So one question specifically about Southern California from the audience, but my follow-on question is, are there other markets that are very impactful if you remove them?
Not to the degree that you see when you pull New York, Miami, and Houston out. I mean, there's the number of rooms in those markets and the revenue generated by that inventory is very substantial. So it does skew the numbers as we saw there. But in this particular episode, I would say the answer is no. I said it that way because, Scott, I'm thinking back previous cycles. You had places like San Francisco that were going just gangbusters, yeah. And then the bottom falls out. And in fact, as an aside, some of you may think we had that once. In San Francisco, because Moscone is closed this year, is going to be an interesting 2017, an interesting year because conventions are going to be way off. That does put a hole in that market. LA is getting continued new supply, particularly I know downtown LA Live and so forth. And as we mentioned, they're dealing with some of the headwinds that come from the strong dollar. And I think there were some issues on the port activity for a while there. But, overall, we think that Southern California, San Diego looks good. And I think, again, Sacramento was at the top of our list in terms of where we see positive RevPAR.
And our LA office, Bruce Bolton, does a special report on right. Southern California that you may be able to access through our website.
Yeah. So that helped, Carl?
Yeah, no, absolutely.
Yeah, Carl, this is Scott. One thing I thought I would mention is that when we do appraisals and do projected cash flow, and we're looking at either acquisitions or refinancing or change of ownership, there's a lot of the underwriters fail to accurately reflect what is needed for the product improvement plan, the PIP. So if we see anywhere where underwriters are undervaluing assets, it's in those circumstances where the chain is requiring the owner to do a significant PIP without any type of forbearance whatsoever going forward. So when you're looking at your cash flows going forward, whether they're being grown as a result of the PIP, make sure there's an accurate deduction for that PIP in your DCF.
No, that's real helpful. Got another question that came in. So about specific flags or hotel chains. Are there any flags or chains that you forecast to be any better or worse than the overall industry?
Wow. Since we do work for just about all of them, we probably shouldn't answer that one. But
or how about this? Why don't I rephrase the question? Without specific names, if you were to say that one was better or worse than another, what are those factors that show a strong flag versus one that's not quite as strong right now?
Well,
we would reflect that in our penetration or yield penetration.
Yeah, but I suspect everybody on the call that's been playing in the hotel space, has to say, and even if you're not, just think about it as an individual traveler or consumer. If you think about what seems to make a brand more attractive, one brand than another brand, and I do think it's, and these are all apostle the obvious types of stuff, but are the brand standards applied consistently? I mean, do I go from location to location? Is the guest experience pretty much the same? Is the value proposition that's offered, i.e., what am I getting for what I have to pay to get it? Is that consistent? There's no question. There's a lot of questions that people have or wondering about. Okay, well, now that Marriott owns Starwood, what should we now look at any of that differently? I will tell you, we don't have an answer to that. It is interesting, some of the challenges that the industry is facing today is hotels that have to now redo their competitive sets because of the SDR business rules, which are totally understandable. That Marriott controls such a large percentage of the inventory. Will managers and owners and lenders and so forth be able to benchmark as effectively as they had been historically, given that so many of these comp sets now are going to have to change? So I think I successfully didn't answer your question. I hope that's okay.
I would also say, Carl, that I think boutique hotels are becoming more into their own, and from an underwriting standpoint, it's certainly nice to have a brand, but there are a lot of boutique properties there, depending upon the market, where it makes more sense to be a boutique property than it is to be branded. And with the distribution that's out there and the channels, I think being a boutique property isn't as bad as what it used to be 5, 10, 20 years ago.
No, that's helpful. Another question from one of our clients in Arizona. Question says, obviously this analysis is based on major markets. What are you forecasting for smaller secondary markets or the rural hospitality markets in general? So this client of ours is in kind of between Phoenix and Las Vegas, which is a broad area.
Yeah, I'm glad you brought that up, because one of the things that we saw in 2016, and we're expecting more of the same in 2017, is that growth outside of the top 25 was measurably stronger than what we saw inside the top 25. So, i.e., smaller communities, smaller markets last year grew at a stronger rate than did the bigger markets, and we absolutely think that that's going to continue again in 2017. A lot of it has to do with they didn't recover quite as quickly off the depths of the downturn, but we're also seeing now that that's where some of the employment growth domestically, it's beginning to happen outside of these top 10, top 20 markets. What we also know is in smaller markets, generally speaking, not always the case, but generally speaking, the inventory is dominated by lower priced hotels as opposed to luxury or upper upscale properties. And what we do know is that changes in employment correlate very closely to changes in demand for lower priced hotel rooms, whereas changes in real personal income levels correlate much more closely to changes in demand for higher priced hotel rooms. So with that employment growth now being a little more pronounced outside of the top 25, that we would expect the demand to lift as a result, and overall performance would be better. That make sense?
Gotcha. Yeah, really helpful. I think I have one more question. Question is, in general, what percentage is being considered, quote, right for replacement reserves, dollar per room or percent of the room revenue? Did you catch that or you can read it?
Well, yeah, it depends. How much can you sneak by your lender? Oops, that slipped out. Scott, go ahead.
We typically underwrite to 4%. Some of the luxury properties, the Ritz-Carlton, St. Regis, they go up to maybe 5% by the terms of their contract. The reality is that over a 8-year period, There's going to be FF&E redo probably, and that's really going to equate to maybe more like 6% of total revenue over a 10-year period. But that difference is usually funded by a capital call with partnerships or refinancing loan, but minimum 4% and 3% for management fee.
Okay, great. Well, guys, this has been great, really informative. We had just about everybody stayed on the call till is still on the call, which is if you know anything about us at Mountain Sea, we try to measure everything, but that's our measurement for a great call. And lots of good questions from the audience. So we will be, well, first of all, thank you to Mark and Scott for taking your time for the presentation. We will be meeting again next month. If you'd like any more information, we're going to send out some information on what Mark and Scott do for CBRE, some not only appraisal work that we do with CBRE and Mountain Seed, but also great consulting work. So if you do have questions about your own market or trends in your own area, I'm sure they'd be willing to work with you directly. So we'll get that information out. Again, really appreciate you guys' time, and we'll send out a recording and slides in the coming days, and we will join you all next month. Thanks so much, guys.
Yeah, thanks, everybody. Bye-bye.